Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, that's where I dive deep into all these sectors looking for potential investment opportunities. Just to give you a little bit of a background of kind of the companies that I'm looking for, I'm looking for companies that can really have a ton of upside for this commodity bull market. I cover a whole bunch of different sectors. I cover energy, coal, oil, uranium, ammonium, fertilizers, all sorts of stuff in there. We've got silver and gold mining companies. I'm pretty picky on the mining companies, so I'm picky on those. They got to have good setups and charts. I cover shipping, tankers, dry bulk, iron ore, base metals like copper, iron ore, nickel. I look at everything commodity related, and then I pare it down into what I think are the best asymmetric plays in the world. And that's what I share with everybody in the community. If that sounds like something you want to learn about or figure out how I do it, special is a coupon code. You can sign up, 50% off the monthly membership for the first month only, and a larger discount, 4 times the discount on a yearly membership if you want to sign up for a year. And you can always switch from a monthly to a year. All right, Tavi says, the battle against inflation is far from over, in my view. The behavior of commodities is very telling. They appear to be leading inflation expectations in a significant way. So this is an important distinction that he's talking about. So let me go back in 2007. 2007, they cut interest rates. I think it was '07. '07 or '08, whenever they started cutting in that general time frame. They started cutting rates because the market was weak. Unemployment was shooting up. The market was super weak. We had a gigantic bubble in the housing market. We were building too many homes. We had way high inventory for existing homes. Foreclosures were just coming in en masse. So when they lowered interest rates, they were lowering it because they were lowering it into weakness. They saw the weakness printed in the numbers, and then they lowered interest rates, and they did it very quickly. That this time that we're going through, I'm trying to see if we've got weakness behind this. So if they lower interest rates, that's generally from a position of weakness, generally. Unemployment numbers is specifically what I'm referring to. Now, what we want to look at is we want to look at, if they lower rates, does the housing market go up? Why is that important? Because the housing market is the cornerstone of that unemployment. So if we see rates drop and housing takes off to the upside, I think that's a very good thing. We could maybe avoid, or maybe the worst is behind us from a recession standpoint. So inflation's picking up here. That's not what happened necessarily. It did it in some of the stuff. It basically, we saw a big move up in oil and a few other things. We need to watch unemployment. We need to watch construction employment. We need to watch all those things. Because if there's weakness, they're lowering rates because of weakness. And that weakness is what is going to scare a lot of people out, even though we're right on commodities here. Now, if they're lowering it for other reasons, and I can't tell you exactly what all those other reasons are, and they let inflation run hot and they drop the dollar, because the thing that's holding dollar strength is strong interest rates. Stronger interest rates against other monetary policies of other countries. So if we drop ours, we could get a very weak dollar against those other currencies. And I think that's what's going to happen. Commodities are going to explode. And if inflation is still out there, it's going to rip. It's going to rip. So coming on down, we've got, let me translate. If you don't own assets, you better find a way to get some and fast. Powell said the Fed has adopted a new framework that removes a reference to the central bank seeking inflation that averages 2% over time, and one to it making decisions on employment based on shortfalls from its maximum level. So he's abandoning the inflation to help the unemployment situation. Now, how bad is the unemployment situation? I don't know. And that's what we need to monitor. We had a big day. I know we're having a big day on August 22nd. This is the 23rd. That also happened in 2007 when they lowered interest rates. It was like some gigantic big spike up. And then we pulled back after that, like a few months after that. Is that going to be similar? Are they lowering rates because of weakness? And this is where you really need to focus in on. Paul said that the Fed has adopted a new framework that removes a reference to the central bank seeking inflation that averages 2% over time, and one to it making decisions on employment based on shortfalls from its maximum level. So this here could send gold and silver to the moon. Because what this is basically saying is that we could enter a stagflationary environment. In a stagflationary environment, it's going to send gold and silver to the moon. That's also why we see some pretty big setups over in silver. Oil, it depends on how this plays out because oil, it likes employment, but it also likes inflation. So things can get a little bit funky in here as we go. Rick Rule says if Trump and Congress are successful in pressuring the Fed to lower the interest rate after the inflation report that was just tabled, that will tell savers and investors around the world that U.S. society has decided to abandon the integrity of the U.S. dollar. 100% right. So if rates drop here, the dollar is going to eat it. So let's look at the dollar here. I'm going to back out real quick. These bull markets are all commodity bull markets when the dollar falls. This was 69 all the way to 1980. This one here was another bull market in commodities, 85 all the way to the bottom of 95. We had another bull market from 2002 all the way to 2008, and then 2011 is this double bottom there. And then we came back up again with increasing interest rates and a stronger dollar, and we could break down out of this to the downside if they were to lower interest rates. And that's what we're looking for. The cycle comes down here, wherever it comes, and bottoms out. That's going to be a big commodity bull market. It's going to send precious metals, oil, copper, a lot of stuff way higher because it's priced in dollars. And then they're going to send the dollar lower. It's also going to create an emerging markets fantasy. Like they are going to rip. So this is what we're watching. This is a key thing to watch if you're an investor is dollar and currency exchange rates. Tim Hack says, wow, silver just activated the 45-year cup and handle. I firmly believe this is the breakout towards 55 to finish the formation, and then we will see hundreds of dollars per ounce. He's correct. And it's being driven by this weaker dollar here. So when that drops, it's going to send it, guys. It's going to send it. Now, I'm not trying to get everybody bulled up here. That's not the point of this. The point of this is to understand the drivers. What is driving gold? What is driving oil and commodities? And they're going to save the stock market. That's what they're going to try to do if they lower interest rates as well. If they can. I don't know what the long end is going to do here. If they go to do it and there's a ton of inflation, you're going to see interest rates on the long end go up. And I'm not exactly sure that they have this all under control here. So then they're going to have to print more money, go by the long end of the curve, and hold this down and do QE. If they do that, they are going to send silver to the moon, and gold, and platinum, and palladium. They're going to send everything commodity related. And what that is, it's not silver and the demand for silver. It's the dollar getting blown out. Now, it could drive more demand to silver as people realize that there's no safe store of value out in the market. Homebuilders looking strong. Of course, when they lower interest rates, homebuilders could break out of this big Livermore accumulation cylinder. You know what else has cylinders? Uranium, iron ore, everything does. Here's iron ore. Look at iron ore here, right? And I'm going to back out. Iron ore is going to get sent here, guys. It's going to get sent. And the opportunities right now in this stuff is that they're low. And these things have some of the biggest moves in commodity bull markets than a lot of other sectors. So if you're not positioned, if you don't know iron ore, you don't know steel, and you don't know some of these sectors, I'm not trying to push this, but it'd be a good time to look at the website, use the coupon code, and figure out how to position for this. Because some of these companies did 50 to 100x last bull market, and we are at a very opportune time to be looking at this right now. That's what I'll say. And remember, iron ore, uranium, home builders, they're all interconnected. Everything I'm talking about is interconnected. Silver price breaking out is interconnected to lowering interest rates, which is interconnected to a weakening dollar, which is interconnected to iron ore and everything else priced in dollars. So the patterns that we are seeing are an imprint of the herd psychology of investors. And they're all lining up for some gigantic move. It could be like a game-ending move for all I know. I mean, these patterns are huge. And they started in 2009, which was the bottom of the real estate market. And yes, I'm one of few to connect this all together. Here we are, new fresh year-to-date lows in mortgage rates. Well, watch what purchase applications do. Watch what home prices do. Watch what interest rates do and mortgage rates. Watch what they do. If they drop and we get a huge surge in buying demand, or it starts going up, I'm on to something. That's what I'll say. Rock Bottom says the US dollar is testing its 14-year uptrend. We're on the cusp of a commodity supercycle, reminiscent of 2002 to 2008. No, it's not the same. It's not the same. Yes, he's right that the dollar is going to drop, and yes, he's positioned correctly. Totally agree. Why is he not right? Because interest. So if we were to go back, let me scoot down a couple. I'm going to skip through a couple of this, and we're going to go back. We're going to go to Grady's chart here, just to show you on uranium. He has uranium versus the S&P 500, if I can find it. Here's one. It's right here. So commodities versus the U.S. stock market. This one will show. You can use uranium. You can do other ones. The 2002 to 2009 or 2008, 9, 11 top here, depending on what this ratio peaked out at. It's probably 08. This here is not going to be the same as us going all the way back up. What's coming is going to dwarf 2002 to 2008. What this is basically saying is that there's this paradigm shift in the market that's occurring. People think this is coming, and a whole nother animal's coming. Like something that people don't even understand yet is coming. That's also why we have a 45-year cup and handle break on silver. This is a different animal, guys. This isn't the same thing. Completely different animals coming. So get ready. Breaking, Powell says conditions may warrant rate cuts. Here we go. Now, a lot of people think that this means that the stock market's just going to rip. I'm not exactly sure on that. We need to watch what unemployment does. If the housing market takes off, I think we'll be okay. But what that's going to do, it's going to send commodities to the moon. It is. NAR finally reported home sales growth over 2024. So here comes the home sales. 0.8% increase. We knew that was coming. August home sales for 2025 will also be up. But in September of 2024, mortgage rates dipped close to 6%. Sales really responded. Year over year comps get harder in quarter four. Here's the illustration as we are coming on up here. So watch this. If we get strength in this, I think the unemployment could be contained. But then you're going to have to go and look at commodities. You're going to have to go look at oil and see what happens there. Because you're probably going to see these things start to run. Anyone in oil and gas, remember 1999. Low, no premium deals lead to high prices. In 1999, we were told to cap all our models at $30 a barrel oil because 31 was absolutely absurd and would never be achieved. Do you know what happened in 2008? $150 oil. You know what's coming ahead of us? That same move. 99 was a little bit before 2001. 2001 was the slowdown. That's when they lowered interest rates. The beginning of the commodity bull market, when oil was like $8, $9, $10 a barrel, was 98, 99. That was the bottom of the market. We had a big surge higher into 2000, 2001. We had a big pullback. That was our wave two pullback. We just went through a wave two pullback on Elliott Wave, in my opinion, for commodities and oil and all that stuff. And here we are lowering rates just like we did before. From there, they went from $10 to 150. Now, I don't know what we would consider to be the bottom. The C19 event, I would say, screwed the oil price up a little bit. So maybe we would consider that the bottom could be something like this here. So the bottom would be like 20 bucks. So take 15 times, multiply it by $20, and I'll do that here. So $20 times 15, we'll probably get something like $300 oil or something. Now, people are going to say that's not possible. And it's like, okay, whatever. That's exactly what everyone said in 1999. They looked at 99, it came up to about $36, came back down to 18, and then we launched. That's the same fractal pattern that we have today. It's the same one. Ultimately, it is not the stock market nor even the companies themselves that determine an investor's fate. It is the investor. Peter Lynch. Lots of laugh. Paul goes max dove and full burns. They're going to run this hot like you can't even believe. And that's the quote I said above. Here's another thing. Canadian crude squeezing into a corner. Equities are already outperforming. Here we are squeezing into the corner for Canadian crude. This thing's ready to break out. Right here is a double bottom. We have a break. This is the best time to accumulate is in this area here before the breakout and a move higher. Everything is positioned for that move, guys. It's all coming together here. We're in a commodity super cycle and people don't even know it. Because all they see is this pullback here. They don't see the big picture. The big picture eludes them. Tim Hack says, if you don't own any silver junior miners, you make a grave mistake. They will quadruple in price in a very short amount of time. In fact, he is right. He is 100% right. And I think that I've identified the best silver junior companies in the world. We are already positioned in them, and we are up a little less than 4x, but we're up. Well, some people might be up 4x in some of them, depending on which ones you purchased. We have a couple that are up about 4x. We have two that I own personally. There's going to be more coming behind it that are also coming, and I think the platinum group metal mining companies that we're in are going to do that easily. And here we are breaking out of the big pattern here. We're just at the beginning here. Oh man, this is going to be fun. You know when this goes up? When they lower interest rates and the dollar goes down. You know what they're going to do? Lower interest rates and weaken the dollar. Guys, it's all in alignment. It's all copacetic. It's good. It's It's got confluence, put it that way. Performance of the best investors of all time, Jim Rogers, Joel, all these guys. Notice that a lot of them are under 10%. Under 10%. 15%, 20%, 25%, and 30%. Go Jim Rogers. Go Jim Rogers. Howard Marks just gave a warning about the current stock market environment, boldly claiming that we are in a stock market bubble. Here's what he said. It does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. The outstanding reason is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors can make? And I've concluded that it is that they conclude that the way things are today is the way that it will always be. And the things that have been happening will always continue to happen. Whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. And I just think that the fluctuations in the market are mostly related to psychological fluctuations. And people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And then that's the continuation that creates bubbles. And you know, where we probably in the early days of that when we talk about liking these assets a little bit too much. So he thinks we're in a bubble, basically. And we are. We are in a bubble. I've got a healthy SILJ versus silver chart, and silver looks like it's going to run much higher. Here's the breakout of SILJ divided by silver. That's what I'm seeing. We could see a big explosion to the upside in the silver juniors. We also have silver that's right out, ready to break to the upside, could go multi-hundred. This is going back to the 1800s, so you can see a downtrend, breaks the downtrend in the 40s. Remember, this is fiscal dominance here. Breaking all the way up, and that cycle went from 1940 bottom all the way to 1980. It was a 40-year cycle. We bottomed out again, and you could say maybe 2000 was the bottom of the cycle, 2004, 2000s back here. And then we're going up for maybe 40 years. So maybe we go all the way to 2040 or 2030s, is something like that. And I think we're going to see a big move in silver here. Big move. And this is just gold divided by the consumer price index. And you can see that's a big breakout. And I can't find anything out there that goes counter to me being as bullish as I am. Like I'm looking all around, I'm like, I can't find anything. Everything looks really good for this to light it up. And this is visuals. I'm not going to go through this. I'm going to end it there. So I think we've got a lot covered there. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special is the coupon code. And that's all I've got for today. We've got a Q&A session Sunday at 5 p.m. Mountain Time. If you guys want to join, you can ask me whatever you want. I am going to go over probably the companies, position sizing, how I determine some of this stuff on position sizing. I'm getting a lot of position sizing questions, and we can dive into it. The companies, the setups, what I look at to determine position sizing, and all that stuff. All right, guys, we'll catch you later. See ya.